Wars have been fought to possess this valuable commodity. People rely on the byproducts of this for almost every aspect of their everyday lives. And stock markets buy and sell this resource around the clock. Of course, I'm talking about oil, or as some call it, black gold.
Frankly, I think there was some exuberance last week after the cut was announced. But clearly, I think we see that evaporating yesterday. So from what it looks like, that is not enough. Mainly because I think there is virtually no demand for oil in terms of transport, in terms of, I would say, economic activity, manufacturing activity in many countries.
At the start of this year, oil prices in the U.S. under the WTI index cost roughly around $63 per barrel. However, things took a turn for the worse due to the impact of COVID-19 and saw WTI hit minus $40 per barrel.
For this year itself, I really don't see oil prices, especially like Brent prices, going beyond the $40 range. Few things need to happen if oil prices really need to recover. One, the shale producers in the US need to really cut down on their production. The Arabs, Saudi Arabia, led by leading OPEC, and Russia need to get their act together and cut more production.
Hello and welcome to Economic Divide with me, Kavit Tathway. This week's show we'll be looking at a production war between Saudi Arabia and Russia that sparked an oil price crisis that, in spite of attempts to salvage the global oil prices, led to the biggest fall in prices ever. Now, before anything, don't forget you can send us your thoughts, comments, and opinions to us throughout the show by visiting our Twitter page using the marker @ED_program. Now, let's get this barrel rolling. We have to start with the headline that rocked the oil price world, namely sub-zero oil prices. On April 20th, May futures for WTI closed at an unheard price of minus $37.63 per barrel for the first time in history. Producers were willing to actually pay traders to take the oil off of them. However, the notion of taking hundreds of thousands of barrels of oil and getting paid for it was just too good to be true, as the reality was that due to a saturation of oil on the market, there were no places left to store it. Now, at the time of writing and making this episode of the show, WTI futures rebounded slightly to $25.09 per barrel, which is still far off the price that it takes to prospect for and produce each barrel. So what sparked this collapse in oil prices for the WTI? The answer comes from a trade dispute between Saudi Arabia and Russia after the OPEC Plus producers tried to negotiate a production cut, but Russia walked out and Saudis responded by undercutting oil prices by $6 to $8 per barrel. Now, it took roughly a whole month of cheap oil and nations filling up on the reduced price before Saudi Arabia and Russia finally came to an agreement. But it was all too late and too little, as prices globally had already fallen by 60%.
What started out as a price war between Saudi Arabia and Russia became one of the key catalysts in the oil price crash that saw global production saturated in excess as there became more oil on the market than demand, meaning that for the first time ever, one particular market, WTI Futures, saw the price of one barrel of oil hit around minus $40.
This is an unprecedented event that basically resulted into a glut in the supply of crude oil, meaning that very, very high amount of crude oil is being supplied with relatively less or very low demand.
With the world suffering multiple layer effects due to the COVID-19 outbreak, the oil-producing nations of the world, many of whom rely heavily on oil as their main source of income, started producing more oil to compensate for the losses due to less demand. However, like in any market, when the product outweighs the demand, the price will come crashing down. As the war raged to gain control of what was left of the market, OPEC saw its production rates hit a 30-year high, with Saudi Arabia, for example, pumping out a whopping 11 million barrels of oil a day. So when Russia and Saudi decided to start an oil price war, the Saudi regime decided to undercut the market by around $6 to $8 per barrel, which of course only made things worse. Finally, when an agreement was made, Russia and Saudi stated that they would cut oil production to stabilise the market. However, it was clearly too little too late, as the global supply had passed demand and the oil markets of the world suffered greatly. Oil tankers, which had become storage depots rather than logistical ships, saw their daily rates rise from $20,000 per day up to $200,000, and in some cases as much as $300,000. However, once again, as OPEC cuts start to take an impact, the rates have now fallen to around $100,000 per day, which is still 5 times higher than the usual daily amount. OPEC Plus have now agreed to cut oil production by just under 10 million barrels per day. Yet with the COVID-19 virus essentially halting multiple forms of oil product use, there's still a high excess of stock on the market, which in theory may mean cheaper prices for the end users in the meantime.
So how exactly was the world duped out of buying up whilst the prices were cheap and selling later? Well, the answer is that by March, oil storage facilities were already at 76% capacity and filling faster than they were being emptied. Oil tankers, traditionally used to transport black gold from source to sale, suddenly took on a secondary role, namely storage. It was reported that tankers around the world were storing roughly around 160 million barrels out at sea. The cost of renting a supertanker had, prior to the crisis that has, been at $20,000 per day. This, however, rose to figures between $200,000 and $300,000 a day. That is 10 times the price. When one considers that oil-producing nations, for example, Saudi Arabia, need to make around $54 per barrel just to break even, you can soon see that the oil price drop is an economic catastrophe for many, especially those who rely on oil for their main source of income.
Donald Trump stood on the podium gleaming that he was the one who should take credit for bringing about an agreement between Saudi Arabia and Russia when they fell out over oil prices. Trump stated he did this in order to protect American jobs in the oil and gas sector. What he did not predict was a rapid fall in US oil prices. As the damage had already been done, the US saw its WTI index hit prices in negative territory, at one point hitting minus $37.63 per barrel, with the US needing to make around $54 per barrel in order to break even. When prices went into negative terrain, it clearly became obvious that the oil producers in the US would become severely affected by the drop in price.
If it's below about $55 per barrel, it becomes marginally okay, but when it goes below 50, less than 30, then it basically crashes the whole operation. And this is what has been the case in the US.
It's estimated that even if oil was at $20 per barrel for a sustained period of time, 533 US oil production and exploration companies will go bankrupt by the end of 2021. Should oil then fall to $10 per barrel, then the number of US companies that could go bust, according to Rystad Energy, will be around 1,100 companies, which obviously equates to hundreds of thousands of jobs lost, and yet another headache for the US economy. Already since the crisis begun, the US has had to shed 51,000 jobs in March alone from the oil and gas industry, through both a combination of low oil prices and the mismanagement of the COVID-19 outbreak by the Trump government. When combined with other jobs lost in the US in the energy field, March and April saw some 303,000 people lose their jobs permanently.
Some companies will also have to take some decisions to lay off staff for as long as the price of crude oil is very, very low. Sustaining all these activities become a challenge.
One of the main reasons for the first heads to fall being personnel are the disproportionately high salaries compared to the national average in the US. Goldman Sachs worked out that the average pay for such a workforce was around 84% higher than the national average, hence why there have been so many jobs lost in the US. What now remains to be seen is whether the 30 million people in America, many of whom are from the oil and gas sector, will ever be able to find their jobs again, and if not, will this blame be placed at the feet of the man who wanted to make America great again, who did so, and then failed miserably.
Mahan Abedin joins us now, our current affairs and impact analyst, to tell us what is going on with the price of oil. So the price of oil hitting negative territory is a concept that many people couldn't understand. Now you have obviously some posts here,
Absolutely.
media posts, as to what is going on with oil prices.
Absolutely. And not only that, what's actually happening with the infrastructure, because people tend to forget there's a whole infrastructure supporting the production of oil. So 384 oil rigs are out of action as we currently talk. And also, it's not just the oil rigs, also the gas rigs. Only 8 of them are operational right now, compared to 183 this time last year. And as of a couple of weeks ago, so this is slightly out of date now, the US was producing 12 million barrels of oil a day. Now that sounds a lot, but if you compare it to the same period last year, it's a huge drop. And of course, it reflects the loss in demand as a result of the coronavirus crisis.
Okay, going on to the next one. This is quite unbelievable when you think about it in terms of what's going on. Looking at this picture anyway.
Yes, about 160 million barrels of oil are currently floating around oil tankers.
You don't think this is an exaggerated picture by any chance?
No, in fact, this is more correct, because the figures I have, again, are from a couple of weeks ago. They're the confirmed figures. Not at all. I think it's accurate. Again, it shows both the loss in demand as a result of the crisis.
Well, that's quite incredible.
The impact on the oil industry is going to be absolutely huge.
Let's move on to the next one. This concerns the UK.
Yeah. So 61.5% of the price of a litre of petrol is taxed. Yeah. A lot of people would be really surprised by that, because historically fuel taxes have been very high in the UK. And I bet your bottom dollar, if you ask any British politician why are they so high, they wouldn't be able to give you a straight answer, simply because it's a really old problem. Fuel tax in the UK was first imposed in 1928, so almost a century ago.
Wow.
And one reason why it's popular for politicians is because it doesn't hurt them during elections.
Sure, very well. Thank you very much for that. We appreciate it. Mahan Abedin, obviously insightful as usual. Okay, we're going to take a look at what alternatives to oil certain countries have, should the slump be a long-term one following the impact of COVID-19 and as markets pick up again. Also, a look at the rise and fall of the petrodollar, and also examine what alternatives there may be. We're also joined by Professor Subhas Bhattacharya, an energy economist from De Montfort University in Leicester, who will be speaking to us in the studio. So don't go anywhere. We'll be right back after this. Welcome back to Economic Divide with me, Kavita Outweighs. In this week's episode, we have been looking at the oil price wars and the slump in the price of WTI crude in the U.S. Now, I'm pleased to say that joining me in the studios is Subhas Bhattacharya, Professor of Energy Economics at De Montfort University. He is an internationally renowned specialist of energy for international development with more than 30 years of experience in global energy environmental issues. The professor specializes in energy, regulatory and environmental studies with a focus on developing country energy systems. Professor, thanks for joining us. Obviously, we're taking a look at a drastic reduction in oil prices. Tell us why that is, and also if this excess in stock is the real reason behind it.
Yeah, I think the dramatic fall in oil prices, that has got 3 major impacts. One is that their export revenue is falling very sharply, and that is then leading to their budget deficits and current account deficits. So that's the other thing. And the third one is that that's forcing the governments to draw down their foreign exchange reserves and also borrow heavily from the market. Now, all of that is then leading to their ability to spend their budgets on health, education, and those kind of basic services. So ultimately, it's impacting their GDP. GDP is falling, and their welfare, social welfare, is also falling.
Okay, let's take a look at how this is going to affect the consumers. You have a surplus of stock that could mean good news for the consumers, from what I gather. At the end, maybe prices coming down. But what about the global economy? Is it going to get back to normal? Will fuel and gas prices rise as the economy recovers? Or are we in a period of low oil prices?
Again, that can be good news for the consumers if the taxes are low, like in the US, or if the governments reduce the taxes. Now, for most of the countries in Europe and in Asia, taxes are not going to be reduced because the governments will use the money to bridge the gap for their budgets for the COVID recession. So that's not going to happen. Perhaps the users may not get that immediate impact. Now, going forward, it will take maybe 3 months to 6 months to get back to the normal. And for that period, the oversupply might be the new normal. And as a result of that, I think we are in for a low price period for some more time.
Okay, tell us a little bit, if you can, Professor, about how this all pans out for OPEC. What are they going to do now? I mean, for the time being, are they a feudal organization, or are we looking at global markets absorbing these shocks from the global financial crisis?
That's a very good question, actually. OPEC has been following traditionally the market regulator role. So it has acted that way, and the production cut that is coming up in May is along those lines. But that raises the question whether it is benefiting the OPEC members or it's benefiting more the other countries or other producers like shale oil producers and high-cost producers.
Okay, thank you so much. That's Professor Bhattacharya with his comments here.
Thank you.
Okay, next up, we're going to take a look at how long the recovery period may take, as well as looking at what industries are vital to make this recovery happen.
The question on the lips of many is, how long will it take for things to get back to normal once the COVID-19 crisis subsides and the oil and gas industry start making huge profits again? The most obvious answer, it seems, could be when the pharmaceutical industry, which coincidentally has been a huge earner throughout the coronavirus and will continue after, finds a vaccine for the virus, hence giving markets stability and peace of mind once again. However, what if it takes 2 years to achieve? Will the global oil market remain at prices so low that it means that it no longer becomes viable to produce oil? How will that affect the industries that rely on oil for their very existence, which, when one considers that nearly everything we do is somehow oil dependent, could spell disaster? With the airline industry being one of the most severely affected, the excess of oil on the market should have meant that travellers could have enjoyed lower fares as the prices slumped. However, with the industry being unable to fly, or at least sternly restricted due to the coronavirus, it seems that in order for the market to pick up, multiple conditions have to be met in order for that to happen.
Yeah, I think the key thing is, how do we get out of this fix? How is storage going to free up? And this is the big problem that many analysts that we've been talking about at CRG. How do we get out of this storage mess that we're in? And what has to happen is demand for crude has to pick up. Well, demand for crude in the US is not going to pick up until we start seeing people driving and flying.
The way we've adapted to live during the lockdown has also meant that we're becoming less and less dependent on fuel, with many people no longer commuting. The use of cars, trains, motorcycles, they've all declined, and may mean that this trend becomes the norm, suggesting the notion that we may never return to a pre-corona lifestyle, at least until a vaccine is found, or until the next global pandemic hits and takes its toll. What now remains to be seen is how governments will react to the lockdown and changes of lifestyle. We know for a fact that the longer the lockdown lasts, the direct and proportional effect on the economy will also be similar. However, should the lockdown restrictions ease over the next few months, which appears to be the case in the likes of Spain, Italy and the US, will people then trust the environment into which they return? And if so, how quickly will the recovery time be in this case? This, and many other questions, only have time as the answer.
Welcome to our Info News section, where we look at stories making economic news around the world. First, the subject of income inequality. You would think that it has gone better due to the COVID-19 outbreak, but think again. Now, according to this entry, the COVID-19 pandemic has exacerbated economic inequality in the U.S., even despite the fact that billionaires' taxes have surged during this period. And this is how it has happened. Between 18th of March and 10th of April of 2020, over 22 million people lost their jobs as the unemployment rate surged towards 15%. Over the same 3 weeks, U.S. billionaire wealth increased by $282 billion, an almost 10% gain based on the study. Next to China, where it is living up to its declared challenge against the U.S. dollar, and this time it has put its word into action. Amid COVID backlash, China tests state-run digital currency to counter the dollar monopoly. The renminbi makes debut in 4 Chinese cities. Now, China is the first nation to do so. China is actually mulling full-fledged adoption by mid-2021. And finally, it is the worst unemployment figure for the U.S. since the Great Depression. As of May 1st, 30 million Americans have filed for unemployment benefits. This figure represents how many filed for unemployment over the past 6 weeks. But what's more alarming is that there are likely more without jobs. Why? Business Insider states that for every 10 people who successfully filed a claim for unemployment insurance, 3 to 4 tried to file but were unable to get through the system. Now, if you have a story that you want to share with us, please don't hesitate to share it with us. You can send us your thoughts, comments, and opinions throughout the show by visiting our Twitter page using the marker @ED_program. As an economic show, we thought we would bring a new section into the program starting this week that will feature every now and then. We'd therefore like to look at some of the great economists over time and introduce their work to you in a brief overview, starting with none other than John Maynard Keynes. He stated that the market for goods controls employment and production, whereas the market for work does not. People becoming unemployed, even if they want to work, is something that happens. That is, since the need for employment fluctuates depending on output and demand. Economic output is strongly influenced by aggregate demand, and that people will tend to save rather than spend during harder times. Keynes also understood that in a market economy, investor behavior is governed by animal spirits of investors, which, when translated to modern language, suggests that many investments are impulsive and instinctive. Let's now take a look at the rise and fall of the petrodollar and examine what alternatives may one day lie ahead.
The US has suffered a double blow due to the impact on the global oil market, and this comes mainly in the form of its interests in the transactions that take place around the world, in the form of petrodollars, with a vested interest in the dollar being the current go-to currency when it comes to trade, with every transaction made in the world that does take place in dollars, in particular in oil, then the US Treasury only seems to gain whether buying or selling. The US, for example, has a long history of buying oil from Saudi Arabia in dollars. The purchase of this oil then see the Saudi regime re-spend the dollars back into the US in the form of military goods, which not only sees the dollars return to the US, but creates endless jobs for American people. However, the status quo appears to be in jeopardy as the world's other leading trading powers realize that there's a gap in the market, with the petrodollar being the dominant force and having no direct challenging competition. The rise of alternative forms of payment are fast becoming prominent, with the likes of cryptocurrencies and other assets being a possibility. There's already a significant amount of global world powers that have moved away from the dollar as the main foreign trading currency, with the likes of China, Russia and Iran, as well as the European Union, all trading in currencies other than the dollar. Could we then see this oil crisis as a stepping stone into another realm of payments, and hence see the death of the petrodollar as a result? In recent years, China has toyed with the idea of internationalizing its yuan as a global currency, either in the form of a petro-yuan, or more recently, the crypto-yuan. Should this happen, then an alternative will be available for the world to choose from, and with China being a major global supplier of everything from goods to hardware, the fall of the dollar could be just around the corner.
There's no doubt that the year 2020 will be remembered long into the future as not only the year that saw COVID-19 cause devastation around the world as the disease spread further, but also due to the collapse of the global economy and subsequent fall in oil prices. With prices falling into negative equity for the first time in oil trading history, what now remains to be seen is whether the oil market will recover soon, and if so, what advantages will the end users see in the meantime? There's also the notion that the fall in oil demand could spark the start of a new era in energy, with alternative energy sources now being a real possibility as we wean ourselves off hydrocarbons. Don't forget, we want to hear your stories and see pictures of what's going on in your part of the world. Do you have cheap gas prices at the pumps where you are at? Send us a picture. Are your energy bills lower than ever? Let us know. Join us on Twitter @ED_program. We can't wait to hear from you. You can watch this episode and any other edition of Economic Divide by logging on to our website, where you can watch us at your leisure. That's just about it for this week's show. I've been Kavitapwe on behalf of myself and the whole team here on Economic Divide. Thanks for watching, and see you again soon.